Okay, so you want to own a car dealership, buy some land, put up a shiny building, park a few hundred cars on it, and watch people hand you money. Local car dealer, richest guy in town, drives whatever he wants, retires at 50. Here's the problem. Almost none of that is how this business actually works. Let's start with the illusion, because the illusion is doing a lot of work here. Across the country, roughly 17,000 franchised new car dealers. Between them, they move more than 16 million vehicles a year. The total sales figure crosses $1.3 trillion. Dealers write more than 276 million repair orders a year. Service and parts alone brings in over $164 billion. Big numbers, the kind that make a normal person think, I want in. The average dealership keeps somewhere between 1% and 2.5%, not 7%, not 15%, 1 to 2.5. Sell a car for $10,000. The dealership might clear between $100 and $250. So how does an industry with margins that thin produce some of the richest people? There are 3 doors you can walk through: mainstream franchise, luxury franchise, or independent used car lot. A mainstream franchise runs on volume, low margin per car, but the manufacturer throws advertising and brand recognition behind you. In exchange, you answer to the manufacturer on almost everything. Facility design, mandatory renovations, inventory you're told you'll receive. Luxury franchises flip the equation. Fewer cars, fatter margin. The luxury segment is expected to keep growing 8 to 14% a year. Building a facility that meets luxury standards costs dramatically more. Then there's the independent used car lot. No manufacturer looking over your shoulder. It's the cheapest way in. It's also the weakest. Independent lots don't get a warranty repair department. They average around $1,500 profit per vehicle, compared to roughly $2,000 for a franchise dealer. The franchise model wins over time. It stacks 3 separate profit engines. Now let's talk about what it costs to get through the front door. Somewhere between $5 million and over $10 million just to open the doors. It starts with the franchise fee itself. For Ford, that fee can be as low as $30,000. For a premium import, past $500,000. Then comes the land. A modern dealership needs 4 to 8 acres. Enough room for the showroom, the service bays, and enough parking. A pre-engineered metal structure runs $120 to $15 per square foot. A concrete tilt-up build runs $250 to $450 per square foot. Manufacturers want proof you can survive. $500,000 to $1 million in pure liquid capital sitting untouched, plus $2 to $4 million net worth. If you don't clear that bar, you don't get the franchise. Add licensing, legal fees, and state bonding. $25,000 to $100,000. Add technology, dealer management software and diagnostic systems, $75,000 to $250,000. And that's before you've bought a single car. Inventory. New cars don't work the way you'd expect. Manufacturers control the flow through a system called turn and earn. The dealers who sell fast get rewarded with more of the best cars. The dealers who sell slowly get starved. The strong get stronger, and the weak get stuck. Manufacturers hold back 10 to 15% of total production at their own discretion. It's less a supply chain and more a political hierarchy. And that's before you've bought a single car. Inventory. New cars don't work the way you'd expect. Manufacturers control the flow through a system called turn and earn. The dealers who sell fast get rewarded with more of the best cars. The dealers who sell slowly get starved. The strong get stronger, and the weak get stuck. Manufacturers hold back 10 to 15% of total production at their own discretion. It's less a supply chain and more a political hierarchy. Used cars are sourced through trade-ins, lease returns, and wholesale auctions. Auctions aggregating hundreds of thousands of cars a week. A car can be bid on and sold in under a minute. Buyers' premiums running from $100 to $500 plus transportation costs up to $2,200. By the time you've paid everything, that great deal might leave 5 to 6% margin once it's sitting on your lot with a price sticker on the window. None of this is paid in cash. Financed through something called floor plan financing, a revolving credit line fronting 95 to 100% for a new vehicle. The dealer holds the metal. The lender holds the risk. The moment a car sells, the loan gets paid off immediately. That inventory sitting on the lot isn't neutral. It's bleeding money every day. Floor plan interest is priced at the benchmark rate plus 2 to 4 points. When interest rates climb, the cost of holding cars climbs with it. Add insurance, lot maintenance, and straight depreciation. Daily holding cost between $40 and $85 per car per day. If you're sitting on 100 vehicles and turn time slips by just 10 days, that's an extra $40,000 to $85,000 gone in a single month. Just the cost of cars sitting still. Floor plan agreements include curtailment clauses. If a vehicle hasn't sold within 90 to 120 days, the lender forces you to make principal payments on a car you haven't sold. Dealers slash the price just to get the thing off the lot, before it becomes a bigger liability than it's worth. Sophisticated dealer groups fight back using last in, first out. The most recently purchased vehicle is the first one counted as sold on paper. That inflates your cost of goods sold on the books, which shrinks your reported taxable profit. It's essentially an interest-free loan from the tax authorities. Everyone assumes the dealer makes their money on the sale of the car. That assumption is mostly wrong. The front-end margin has been shrinking for years, thanks to the internet giving buyers instant access to invoice pricing. The average gross profit on a new vehicle recently dropped by around a third. Used cars offer 12 to 15% gross margin, compared to around 7% on new. So where's the rest of it coming from? The finance and insurance office. The room you sit in after you've already agreed to buy the car. That room generates close to 37% of a dealership's entire gross profit. The bank offers the dealer a wholesale rate called the buy rate. A 5% buy rate might show up on your paperwork as 7%. The dealership pockets the spread. It's called dealer reserve, and it's pure profit generated from nothing. Then there's the extended warranty, technically a vehicle service contract, and gap insurance that covers the gap between what you owe and what the car is worth. These products carry brutal markups. A warranty costing the dealership around $1,000 might be sold for $2,500 to $3,500, a markup of 50 to 200%. Well-run finance departments attach a warranty to as many as 84% of all deals. That's a second business running quietly inside the first one. Now here's the trick almost nobody outside the industry has ever heard of. Some owners don't just sell these products for a one-time commission. They set up their own offshore reinsurance companies, often places structured specifically to hold tax advantages. When you buy that warranty, the premium doesn't vanish into the manufacturer's pocket. It gets routed into the dealer's own captive insurance company. If your car never breaks down, the dealer keeps the entire underwriting profit. That underwriting profit can be exempt from standard taxation up to an annual cap. The cash in these captive companies doesn't sit idle. It gets invested in stocks and bonds, quietly compounding in the background, completely separate from whatever happens on the actual sales floor. That's the real secret. The car is basically the bait. But even the finance office isn't the most profitable room in the building. That title belongs somewhere you'd never expect: the service department. Fixed operations account for only 10 to 15% of total revenue. And yet that small slice generates roughly half of the entire gross profit, because margins back there run between 45 and 50% on labor and parts. Car sales are moody. They swing with rates confidence the economy. But cars need oil changes and brake jobs regardless of the stock market. Fixed operations is the department that doesn't panic during a recession. There's a number owners obsess over: the service absorption rate. It measures what percentage of fixed overhead gets covered by parts and service. The industry sets a target of 115% absorption. Once you hit 100%, every car sold afterward becomes pure unencumbered profit. Most dealerships only manage between 64 and 69%. The ones that push past 100 are the ones quietly getting rich. Technicians aren't paid by the hour they physically work. They're paid flat rate. Every job has a preset number of hours attached. If a brake job is booked at 3 hours, the tech earns 3 hours whether they finish in 1 or 5. A skilled technician can bill 60 or 70 hours inside a normal 40-hour week. For the dealership, this eliminates the risk of a slow mechanic costing them money. Good months are very good, and slow months can be brutal. Sales staff work on commission, usually 20 to 30% of front-end profit. But before that commission is calculated, the dealership takes a cut called a PAC, an arbitrary internal number deducted before the salesperson's percentage is calculated. It's a quiet mechanism that guarantees the house always skims something first. When a deal is too thin, the salesperson gets what's called a mini, a flat guaranteed payout, just so they don't walk away with nothing. Every dealership runs on a dealer management system. This market is essentially controlled by 2 legacy companies. Because switching systems is so disruptive, these providers charge almost whatever they want. Base monthly fees run between $3,500 and $9,500. Integration fees can exceed $32,000 a year. It's a quiet, unavoidable tax. Very dealership pays just to keep functioning. Now let's talk about the price on the windshield, because it's not really the price. You negotiate down toward what you think is the dealer's actual cost. The invoice price, except the invoice price is inflated on purpose, usually by 1 to 3%. After the car is sold, the manufacturer quietly refunds that back in a check called holdback. You think you won the negotiation. The dealership already built the win into the math. Then there's the documentation fee. In heavily regulated states, that fee is capped at $85. In deregulated states, the average doc fee runs past $1,100. Same paperwork, same printer, wildly different profit depending on which state drew the line. By 2024, Ford scrapped the program. The dealers who'd spent the money didn't get it back. There's also a constant undercurrent of regulatory risk. Rules requiring visible warranty disclosures on used cars, strict cybersecurity requirements to protect customer financial data, lending laws that can turn a hidden finance charge into a six-figure fine. They're the ordinary cost of operating a heavily leveraged, heavily regulated business. One HR department, one customer service center. It gives them leverage to negotiate the software fees down. And critically, it diversifies risk. If one manufacturer has a terrible year, the group's other brands carry the weight. It turbocharges the reinsurance model. A group processing thousands of warranty contracts a month across multiple brands, generating investment returns that can dwarf the profit of the actual showrooms. So what does a dealership actually make? The average franchise dealership pulls in close to $60 million a year in total sales and clears somewhere between 2 and 2.5% of that as net profit. The average front-end profit per vehicle sits around $2,000, and that number alone isn't close to enough. It has to be propped up by the finance office and the service department. The owner's official salary usually falls between $112,000 and $277,000 a year. That number looks almost ordinary, but it's a fraction of the real picture. Add distributions from dealership profit. Add rent, because many owners hold the land in a separate company and lease it back to their own dealership at a premium rate. Add dividends quietly flowing out of an offshore reinsurance company most customers will never know exists. Once all three layers stack together, total compensation reaches into the high six figures, and for the ones who expand into multiple stores, into the millions. So, is it worth it? This isn't a business for someone without serious capital. And it isn't passive income under any definition of the term. It demands millions in leveraged debt before you sell a single car. Total dependence on decisions made by a manufacturer thousands of miles away. You're managing technicians, running a sales floor, negotiating logistics, structuring tax strategy. When new car sales freeze, the service department keeps the business breathing. The car was never really the product, it was the entry point.